What is the U.S. Federal Reserve System? The Federal Reserve, commonly called the Fed, is the central banking system of the United States. It was created on December 23, 1913, under the Federal Reserve Act. The main reason the Fed was created was to prevent financial instability, bank failures, and economic panic. Before 1913, the United States experienced repeated banking crises. People would rush to withdraw their money, banks would collapse, and the economy would suffer severe damage. The Fed was designed to stop these situations from happening again. Its mission is to maintain financial stability, support economic growth, and protect the banking system during times of stress. Simply put, the Fed is the financial heart of the U.S. economy. It manages the flow of money the same way a heart pumps blood through the body. Without a central authority like the Fed, every bank would operate independently, leading to chaos and instability. Who controls the Federal Reserve? The Federal Reserve is not controlled by one person, one bank, or one political party. At the center of the system is the Board of Governors located in Washington, D.C. The board consists of 7 members. Each member is nominated by the U.S. President and confirmed by the Senate. Governors serve 14-year terms, which helps protect them from short-term political pressure. The chair of the Federal Reserve is chosen from among the board members and serves a 4-year term. The chair leads meetings, communicates policy decisions, and represents the Fed publicly. However, the chair does not make decisions alone. The Fed also includes 12 regional Federal Reserve banks across the United States. Each regional bank monitors economic conditions in its area. Monetary policy decisions are made by the Federal Open Market Committee, known as the FOMC. The FOMC includes the 7 board members and 5 regional bank presidents. Decisions are made collectively, ensuring no single person controls monetary policy. What are the Fed's main responsibilities? The Fed has 5 core responsibilities. First, monetary policy. The Fed works to control inflation and support maximum employment. It adjusts interest rates and liquidity to slow the economy when inflation is too high or stimulate it when growth is weak. Second, financial stability. The Fed monitors financial markets and acts to prevent systemic crises. During emergencies, it can provide liquidity to banks to stop panic and protect the economy. Third, bank supervision and regulation. The Fed oversees banks to ensure they operate safely and responsibly. This helps protect depositors and maintain trust in the financial system. Fourth, payment systems and currency management. The Fed distributes U.S. currency and operates major payment systems that move money between banks. Every wire transfer or large bank settlement relies on Fed infrastructure. Finally, consumer protection and community development. The Fed supports fair lending practices and works to improve access to financial services, especially in underserved communities. Together, these functions make the Fed a central pillar of economic stability. How the Fed affects the U.S. economy. The Fed influences the economy mainly through interest rates. When interest rates rise, borrowing becomes more expensive. Consumers spend less, businesses invest less, and inflation slows. When interest rates fall, borrowing becomes cheaper, spending increases, investment grows, and economic activity accelerates. Because U.S. interest rates influence mortgages, business loans, credit cards, and investment returns, Fed decisions affect nearly every household and company. How the Fed impacts the global economy. The U.S. dollar is the world's primary reserve currency. Many countries trade, borrow, and save in dollars. When the Fed raises interest rates, U.S. assets become more attractive. Capital flows into the United States, strengthening the dollar and pressuring other currencies. When the Fed lowers rates, capital often flows into global and emerging markets, increasing risk-taking and investment worldwide. This is why Fed decisions create global ripple effects. The Fed's monetary policy tools. The Fed uses several tools to manage the economy. The most important is the federal funds rate, which influences all other interest rates. Another tool is open market operations, where the Fed buys or sells government securities to add or remove money from the system. The Fed also uses the discount rate, which is the interest rate it charges banks for short-term loans. In addition, the Fed can adjust reserve policies and use modern tools like interest on reserves and overnight liquidity facilities to control financial conditions. Is the Fed independent? The Fed is operationally independent but legally accountable. It does not take orders from the President or Congress on daily decisions. Interest rate choices are made independently. However, the Fed reports regularly to Congress and operates under laws set by Congress. Its mandate is defined by legislation. In short, the Fed is independent in action but accountable in structure. How the Fed influences crypto markets. The Fed does not regulate cryptocurrencies directly, but its policies strongly influence crypto markets indirectly. Cryptocurrencies are considered high-risk assets. Their prices are sensitive to liquidity and interest rates. When interest rates are low and liquidity is high, investors tend to seek higher returns. Crypto prices often rise in this environment. When interest rates rise and liquidity tightens, investors move towards safer assets. Crypto prices often fall. This pattern has repeated multiple times in recent history. The Fed also influences the US dollar. A strong dollar often pressures crypto prices, while a weaker dollar can support them. In times of financial stress, the Fed's actions to stabilize banks and markets can indirectly stabilize crypto assets, especially stablecoins. Final summary. The Federal Reserve is one of the most powerful economic institutions in the world. It controls interest rates, manages liquidity, protects banks, stabilizes markets, and influences global capital flows. Even though crypto operates outside traditional banking, it still reacts strongly to the environment created by the Fed. Understanding the Fed means understanding the forces behind inflation, markets, and crypto cycles. If you trade or invest without watching the Fed, you are missing one of the most important drivers of financial markets.